We have about 22 participants so far. Others are joining one by one. Can anyone unmute your mic and say you can hear me?
Yes, sir, we can hear you.
All right, thank you. I think last time we stopped somewhere here. I said I will do to summarize what we have done on the first day. What we did was we gave a definition to what is credit, and then what is risk, and what is management. So credit risk management is actually we have divided into two parts or two categories. One is we call it counterparty risk. The other one is concentration risk. So credit risk, counterparty risk is actually the default risk, which is indicated from your NPA in your banking book. Concentration risk is where you have put your money. That means to which industry, which region, which product you have concentrated your giving of credit. That means the portfolios of your bank are divided into several industries. So one first industry portfolio means you divide all the credits into, central bank has given about 11 categories. We put them into each box. That means if you are given facility to agriculture sector, we put under agriculture. If you are given to a manufacturer, we put under manufacturer. Similarly, if you are given for credit to trade, we put under trade, tourism, transport, so on. We are going to look at it in details today, what are these portfolios are. Then that part where concentration is actually the act of the lender. Earlier, the counterpart is the act of the borrower. So borrower's inability to pay will result in non-performing advances, which is credit risk. Non-performing advances is a, I would say, a measure or a key indicator of how the bank is exposed to credit risk. So to analyze this, we put the entire credit process into two parts again. I would say two different sides of a coin. We said credit risk can be managed by the business unit. We call it credit management. Then we have a specialized credit risk management unit under the risk management department of the bank. We have a credit risk management. So first is credit management, the second is credit risk management. Under the credit management, we looked at the entire credit process. Starting from customer walking in, or you are canvassing a customer, then loan origination, thereafter evaluation. Evaluation, we said you could do financial evaluation and qualitative evaluation. Then you prepare credit appraisal form. All these different functions are to manage credit risk, because if you take the correct information and you do your evaluation right, you do your ratio calculation right, and then you prepare a paper which, you know, in the eyes of an analyst can say we are going to get this money when we give, or there are too many risks that we should not take this kind of facility into our books, is the part of the credit management, which is done by the business unit. So actually mostly counterpart risk can be avoided or managed from the business unit itself, but you get support. You get support from the credit risk management unit of the risk management department. since of late, in 2007, the Central Bank of Sri Lanka introduced risk department to all the banks, and they say they need to manage all types of risks. And we also looked at the type of risk the bank undertake. We said financial risk, strategic risk, operational risk, regulatory risk are the main categories. Under financial risk, we have credit, market, and liquidity. So we have a small portion of the total risk that need to be managed by the bank, which is credit. However, in the size from the balance sheet of a bank, generally it's about 70% of the balance sheet includes your loans and advances, and that is which is exposed to credit risk. So size of the balance sheet gives us a different picture. It says the highest amount of risk or the highest value of risk is in the credit. So that's why we pay a lot of attention for management of credit, because what we lend is not the bank's own money or the shareholders' money. What we lend is the depositors' money. We need to pay them back with interest. Similarly, we need to collect credit what we have granted with interest. So risk involved, even if you collect your capital, you are running a risk, because you will run into a loss situation because your deposits you need to pay. So actually bank's profit is depending on the total amount of what you get as deposit and the interest what you paid, which is interest expense, and the interest earned from your credit activities is interest income. The difference is your net interest income, which is very vital for banks' profitability. So that's why we pay a lot of attention to collecting the money what you have given on credit with interest on correct due dates. That's what you call credit management. So that is counterparty risk management. Today we are going to discuss, now I gave a brief idea of what we have discussed on the first day, and I went on to do evaluation in 3 different types, that is retail credit, SME credit, and the corporate credit. What we looked at is the borrower's risk. That means your credit customer also get exposed to different risks. And if those risks are much higher for him, and if we go to fail with those risks, your facility will not come through, will not be repaid. Therefore, it's important for us to analyze and understand the risks faced by our customer. That's why the evaluation is being done. We went on to do financial ratio calculations, which is another part which we have done in another program, but I briefly touch on that for you to have understand about different business models of customers. Today we come to another area called specialized credit. Now, specialized credit, what I mean is also credit. This will be done for mainly trade, and mainly trade of import and export trade, which you need to know, because this gives us good income, good interest spread, short-term lending, because money will come back quickly, and also we get huge fee income on this. Commissions, exchange income, different letter of credit opening charges, extension charges, all that will be coupled in this particular type of credit. And this type you need to understand as a specialized credit area. I'm going to go back to the board to give you an I will sit and write so I can see that you also can see. Letter of credit is generally, we call it, now we will take an example. You have a customer A, and A's bank is, say, B1. We say A is in Sri Lanka and B1 also in Sri Lanka. Now, A wants to do trade with customer C, who is in a different country. And he also has a bank, you name it B2. Now, if we consider A as an importer and C as an exporter, if A wants to import something from C, first what we will get is C will originate a pro forma invoice. That means it will have a description of the goods, what is going to send, terms of transaction, how it's going to take place, amount of money involved, whether insurance is to be arranged by the C or A, all that is included here. We take, for example, C send the pro forma invoice. He says, I am willing to send you goods provided you open a letter of credit in my favor. So what does A does is, they bring this pro forma invoice to the bank and request for a letter of credit. Letter of credit is an instrument where B will issue to A on behalf of A and send it to the C's bank. So LC will get transmitted to B2. B2 you will inform C that you have a letter of credit in your favor issued by B1 bank on behalf of your customer A1, and the terms of conditions, all that are mentioned in that letter of credit. Now, this letter of credit will be established based on the A's credibility or creditworthiness. There we are. Oh, good morning. So, B1 bank has opened a letter of credit on behalf of A, got it transmitted to B2, and B2 has informed C. Now, this letter of credit, I told you, will be issued on A1 by B1, A on behalf of A by B1 bank, that is domestic bank, based on the creditworthiness of. Sometimes they could ask for margin or ask them to establish a separate letter of credit line. Now, how does letter of credit operate is, now C gets this letter of credit. C need to, based on the terms of this letter of credit, C will send the goods to A and present the papers or the documents to his bank. So at the time of send goods, sometimes he may not have money, but he has a letter of credit in his favor issued by a foreign bank on behalf of his customer, trade customer. So C sometimes can go to his bank B2, will say, in order to send these goods, I may need some money. That money will be given by way of a packing credit line. So on the basis of the letter of credit what C has received, he could apply for a packing credit. Now once he got the goods in order, ship it, submit the documents here to B2, and he can request his bank, you can purchase these bills which is prepared according to the letter of credit what I have received, and the goods have now been shipped, and that facility we call foreign bills purchase. So what does bank B2 does? Originally grant a packing credit, then take the bills by the exporter and purchase it, and the proceeds they will allocate to the packing credit what they have granted and recover. Balance will be given to C. Now goods will arrive here. Goods will come to the port. Documents will come to the bank. B2 bank will send the documents to the B1 bank, which is the importer's bank. And bank, if A1 has money, he can pay the value of the documents and collect the documents from the B1 in order to clear the goods from the port. But if he doesn't have money, he also can ask for a facility. We call it, that facility is a loan, revolving import loan. So once I put brackets because you have already established LC. Within that LC, he asks for a, within that value, he can ask for a revolving import loan. He cannot ask for a loan more than higher than the LC value, because LC value covers the total value of the shipment. So he take this money and pay the bank. Bank will retire the LC and give him the document so he can go to the port and clear his goods. This is a letter of credit, how it's operate. Now, if A wants credit from his supplier, instead of letter of credit, we call this site. Because moment he looked at the documents, who collect the documents to his hand, he need to pay money by way of a loan or by cash. If we get credit from his supplier, this letter of credit will become LCU, letter of credit usance. Usance means similar process will take place, goods will come, but he need have to pay money at the time of collection the documents, because you don't have to retire the bill on site. There is a due date given for settlement. Until such time, bank P1 do not need to, there's not necessary for him to pay the money back to B2. So that duration is called letter of usance, and what we get is, we get the acceptance of documents from the customer and we release the documents to him so that he could collect the goods. That is one way of doing trade finance, or you could say foreign trade. Now, there are other ways. Now, a customer, instead of opening a letter of credit, he will say, you send me the goods like before. Once the goods come, I will pay. This we call it collection. Originally, there was a transaction where a letter of credit has been established. As a result, C was able to get a packing credit, and those bills are presented. He can get a foreign bills purchase. Sometimes, what we do here is C directly as a pro forma invoice, but A says, my terms of settlement is not letter of credit. You send me the goods. Once the goods have been received here, I will pay you. So we call it bills come on collection. Bills come on collection also can be similar to letter of credit. Can be immediately, you need to pay money to get the documents in order to clear. Or you can ask for a collection period for them to pay. So similarly, once that comes, if you need to pay, if delivery has to be done on payment, we call it DP. If delivery has been done and the payment is later, we call it delivery against acceptance. So there's another way of doing the transaction without opening a letter of credit by way of collection. Now, what are the credit here involved? We open LC, we get commission. If we give him an import loan, revolving import loan, we get interest. If it is an exporter, we can give packing credit, we get interest. We can give them a foreign bills purchase facility, which will charge commission. And these transactions also involve exchange income, because when you buy foreign bills purchase, you apply the buying rate of the foreign currency. Similarly, when you open LC and if you need to retire that, you apply the selling rate of the currency. All that involve profits to the bank. Now we looked at letter of credit, letter of usance. We looked at the collection DP and DA. Now there's another way of it. C says, no, I can't send on collection. I need to get money in advance in order to send the thing. So A need to send money direct to C by way of a remittance. We call it advance payment. So the payment has been received by the exporter, then he prepare the goods and send it to the importer. So there's no, he can directly do this transaction without involvement of a bank, because involvement of the bank will be the remittance what you made. But there are restrictions by different governments. You may not be able to remit large amount of money for import of facility this nature. Now we looked at advance payment, letter of credit, letter of usance, DP. Now, A says now, A can demand, as an importer, you send me goods. After I receive, I'll pay you. So goods will go there. We call this one you need to have a good trade agreement between A and C in order to perform this sort of transaction, because A can clear the goods. After that only he will decide whether I am going to pay or not. So when you do open account exports, you are at the mercy of the buyer. Mostly our tea trade, cinnamon trade are done on this basis because those foreign buyers have created the demand, and they have demanded that we should send the quality goods for them to pay. So we have different types of settlement plans for this foreign trade. You can use advance payment, letter of credit, letter of usance, use DP or DA, or do the transaction open account. Now, I'll go back to my slide. Here what happened is, you looked at credit risk to export. We have customers who do exports, we have customers who do imports. Exporter goods dispatch on open account, and the importer defaults due to change in market conditions and bankruptcy. So mostly we have in Sri Lanka, we found our exporters used to do transaction of this nature, and over a period, suddenly the buyer get vanished or buyer get bankrupt. As a result, his proceeds of exports will not arrive in Sri Lanka. And if bank has granted packing credit for such customers, also will suffer credit risk. Country risk. Now we also have various other areas in this. Country risk to export. Once again, you send the goods to customers in overseas. In those overseas countries have different type of regulations. They have licensing requirement, tax requirements. Sometimes suddenly they may introduce a ban on certain items. That time, if you have already done the import, or they will have exchange controls regulation coming suddenly. As a result, the importer will not be able to send your money. These are part of some of the country risk you faced when you do exports. Apart from that, we also have fraud risk. We say, we take for example, advance payment made and exporter failed to supply goods as agreed. I told you one of the risks involved in our payment of pay in advance. Importer will get the money, will send the money, and exporter, on the other hand, will have received the money, but he has not sent the money or sent inferior quality or obsolete goods. As a result of a fraudulent act, the importer might lose. And when the importer loses, if you have given facilities to the importer, we will have a credit risk. So bankers' role in this particular specialized credit is not only granting credit, it also need to do a kind of, you need to become advisor to your customers about the method of payment. You may be able to collect some status report of the buyers. You can get country reports You can, from banks, you can get market reports, exchange regulations in part of the country where your customer is going to trade with. All that is need to be passed on to your client so that he will not have a situation where the money will not come. So banker's role is more or less advisory as well as funding facilities to facilitate trade finance. So this area you need to have a special knowledge, because this area risks are not only counterparty risk, not only concentration risk, it has the country risk, we have fraud risk also coming into play in this particular type of credit. So that with that, we conclude the credit management side of it. That means we looked at the business management side of the credit area, where you can use several techniques from evaluation to loan origination, um, taking precautions when you're doing specialized credit, your ratio calculations, your qualitative calculations, your loan documentation, your security taking, all that involve risks. And on the management side, if you apply the correct procedures and do a correct evaluation, you could avoid to a great extent credit risk to the bank. So managing counterparty risk is not only the risk management unit department's responsibility, but mainly it is the credit management side, or the business side of the credit is the people who need to manage this particular risk of counterparty. Now we are going to go back to our back office function. Back office function is done by risk management department. In risk management department also we'll have several subunits: market risk management, credit risk management, liquidity risk management, compliance risk management. All that will comprise of a risk department. So they will have credit risk management unit. So I would say this is part of the same coin, but two sides of the coin, can be heads or tails. Credit management and credit risk management is the same coin, but there are two sides to it. So we'll see credit risk management process. Now I also need to elaborate to you another area, which I am going to the board again. you could see what I wrote, I said risk management. Now I have omitted the credit part of it. Credit will say credit risk management also same, which has, it's a process. Any management, any kind of management is a process, because you need to follow the process to manage any kind of a risk or any kind of particular management area. And in risk management, this process has different parts. You need to manage a risk. In order to manage risk, you need to identify the risk. That is the first part. You need to know where the risk is. That's why we take so much of information from customer, from loan origination, and then once you identify the risk based on the information what you have got for a facility, then second one is we call it measure. Measure is the part of evaluation. In credit risk, measurement, in management we say you cannot manage anything unless you measure the things what you need to manage, or measure the risk, amount of risk what you are going to undertake, either way of quantity. You need to quantify the risk what you are going to manage. How we also call it how much money you are going to lose as a part of credit risk. So if you know exactly when you give a facility, this facility could go bad. If it goes bad, amount of money what you are going to lose, if you can measure in advance, it's very much easy to manage this credit risk. Second one, third part is we call it respond. In credit, once you do your origination, that is take information and do an evaluation, which is measurement. The next part is to respond either positively or negatively. We call it approved or declined. You have this concept in banks. Once the credit paper is been prepared, it will be sent to a management authority for his approval. And that part we call it a response. Response can be positive or negative. That means you can approve the facility or decline the facility. Once you approve the facility, if your response is approved, then you have a few more steps to go through in this process. You just can't just give a loan and just keep quiet, because you need to monitor whether repayments have been received regularly. And monitoring is a very important area of credit risk management, because that's where the information extracted originally to see whether there's a counterparty risk. While you are doing monitoring, what you do is you review a customer's creditworthiness at different period of time. Mostly banks do annual review as a monitoring measure, but where large facilities are concerned, central bank is interested and requested the bank under their directions to do at least 35% of the total credit granted annually, so that they can monitor the facilities. While monitoring, if the payments have not been received, if the wrong signals have been created by the counterparty that there's a difficulty in repayment, then the banks need to take action. The fourth part is control. That means if a customer you are considering sometimes customers do overtrade, sometimes his borrowings are higher, then you specify certain limitations. Those limitations are we call it control measures, in order to minimize the risk and recover the exposures what you have already given to this customer. So the last part is we call it report, because in management you need to inform the senior management of what's happening. So generally in credit, you have several management information stream to report to your hierarchy what's happening, the credit portfolios are concerned, what is your NPA ratio. These key risk indicators will give them the management to recommend further controls or further monitoring measures for you to act upon. So this reporting is important. So risk management or the credit risk management involved to identify the risk, measure the risk, do a response, and then monitor, control, and report. So we'll go back to our slides again. We talk about a process. Now, to do that, I have stated some of the things what we practice in banks in this credit risk management process. You need to understand the credit strategy. Some banks will target certain markets. Now, say if your bank wants to increase the leasing portfolio, they will have a campaign and they will target a market segment to promote this product. So you need to understand time to time banks' credit strategy will change. They will say put more concentration on SMEs rather than corporates, or concentrate more on agriculture. This time is good for housing. So that sort of strategies you could get. Credit department need to understand what are the strategy of the bank. Formulation and implementation of credit policy, procedure, and lending guidelines. Now, risk department has a huge responsibility. Along with the business unit, any management need to have a framework to run. Now, say when I say framework, if you need to run your credit department, you need to have a policy. Policy is a document where you list out the terms and conditions. How do you grant credit to different products, different regions? Then also you explain the proceeding need. Now, say credit procedure is what type of structure you will create for a client. Now, say for you, your procedure is, will say if you want to give a housing loan, you don't give that person an overdraft. You give a long-term facility. So these procedures, how to grant facility, what securities to take, where to register those securities. Most of the banks have this credit administration department, which is required to run, make sure that procedures have been followed. They also go through, some banks have this, we call it lending guidelines. Some have embodied this into the credit risk policy manual itself, but some have a separate lending guidelines. Lending guidelines are for, now say, for example, all the industries will not have the same type of risk. We'll take, for example, garment factory and a tourist hotel will have two different ways of risk in their managing their businesses. Garment factory may need to do a quality product. They need to identify a good buyer overseas, then ship it on time. All that is needed. Now, whereas tourist hotel need a different. They need to increase their occupancy rate. They need to provide all the convenience to their customers. So you look for different type of credit guidelines to consider facilities for two different type of customers. So these are listed in this lending guidelines. So credit risk department has a responsibility to create this policy, credit risk policy, credit procedure. They will have to, along with the business unit, they have to create a credit policy manual or procedure manual, and then also to prepare lending guidelines. They also need to establish a credit management structure. I told you in management framework has policies, procedures. The other one is a structure. Structure is your organizational chart. Now, to explain this, you will have, we'll take a branch, for instance. Branch, if I am a customer, I want credit facilities, sometimes I can go direct to the manager. Or generally in a branch, we will have an officer who is in charge of credit. So as a customer, my first visit will be to meet this particular officer whose subject matter is credit. And all my requirements will be told to him, and then probably he might consult the branch manager, and between them they will discuss my requirement and also type of facilities the bank could grant, and then prepare a paper. Now, if my facility is a small amount, probably manager itself will be able to approve this facility. Just imagine my facility is kind of a little bit larger one. These managers have a limitation. We call it delegated limits given to them. So within that limit only they could approve facilities. Anything larger or complicated in structure sometimes may need to forward the credit appraisal form to a hierarchy, probably in a centralized unit or in head office for approval. Or sometimes we have this branch network has these regional officers, and those regional officers, they have their regional managers. So if my facility falls within the limit of the regional manager, they will submit to the regional manager, and he or she may be able to approve it if it is within their limit. If not, if it is even higher, they will send to centralized office in our head office to the head of credit to approve my facility. Sometimes head of credit also may not have the delegated authority to approve my facility. Then he will refer to, most of the banks have this committee called, they will first submit to the CEO. And if he doesn't have the limits, they will have internal credit committee. That committee may consist of few members and they will approve it. If all those within that organization structure is unable to approve certain facilities due to its quantum or the complications, they will refer it to the board of directors for approval. So it can, in your organization of structure, can go from credit officer to branch manager, regional manager to head of credit to CEO, internal credit department, or even it can go to board of directors for approval. So this is these delegated authorities of these different officers, and the structure has to also be time to time evaluate and establish by the credit risk department, or they need to propose the structure and the board of directors could approve it. Then the introduction of regular validation of internal rating system. Now, most of the banks now want to systemize or computerize the credit process. In most of the other part of the world, or especially Western world, USA, everyone has a thing called credit rating. Any customer has a credit rating. Now, we have in all the banks have credit rating. You may have heard Bank A has a Fitch rating of AAA. Bank B may have a triple B. Those ratings are credit rating. That is, will show the credit worthiness of a customer. So if you have credit customers, a large number of credit customers, it's better to create a rating system for them similar to what Fitch does for the bank, and record it somewhere so you know that this rating will also give some kind of assurance that if the ratings are acceptable, you may be able to disburse facility quickly and possibly based on the rating. So most of the banks have this internal credit rating system. The results, how it is created is similar to credit scoring. Credit scoring is very simple, but internal rating system may take into account all the ratio calculations and the thresholds what your bank has given for those ratio calculations for different industry types, and if a customer provide collateral, what additional points it can be given, if his product is based on marketability or the market share they have for the product, you have different scoring. So financial as well as qualitative aspects will be taken into consideration in creating various platforms to analyze the customer's creditworthiness. And this creditworthiness is summarized. If those points are generally added up, a customer gets over 90, he might get a rating of AAA. A customer who gets between 85 to 90 may get AA. So you create a scoring system and you attach a numbering system to that. So if 90 and above is AAA, 85 to 90 is AA, 80 to 85 is single A, between 70 and 80 triple B, 65 to 70 double B, and 60 to 65 single B, and below 60 is C. And if bank decide we will only give facilities to customers above B, that means their total marks should have reached at least 60. So we call above that level, that is B and above, or 60 points and above, is we call it an investment category. So you deal with customers whom you can rely on for repayment. So that's why we need to do this internal rating system, and we need to revalidate. That means some of the parameters set in this may not time to time need revisions, and those revisions has to be done by credit risk. We also need, credit department also need to do a credit control process through prudential limits for industries. Now, at the moment, I told you central bank has given 11 type of industries, and credit department need to suggest to the board of directors maximum amount of exposure to a different industry. We'll say these days tourism, it has hit by various other aspects, COVID and this attack, and as a result it's not a lucrative industry. When a situation of that nature comes, you put a limit, says bank's total exposure to tourism will reduce to 6%. So that limit, 6% of, we'll say bank has 100 billion facilities, you can give up to about 6 billion to this particular industry. That particular limit is, we call it a prudential limit for industry. We also have large exposures. We have customers who have borrowed very high values. Most of the banks has something called single borrow limit. I'll explain to you later. The single borrow limit is the maximum amount you can lend to a single customer or a group of customers. So if you have exposed, we'll say bank has about 10 large customers who have taken, say, 75% of your total facilities, and if some of them fail, will have a very big impact on your non-performing assets or non-performing loans. Therefore, you need to have certain limits for these large exposures. And central bank also has guidelines to what kind of exposure you should have for large customers. Then I also called about single borrow limit. Then there's another thing called related party. That means when you lend to your directors and connected parties, there are certain rules and regulations established by central bank. So you need to follow that. Managing credit concentration and specialized portfolios is also part of credit risk management. This can go on. There are responsibilities enormous, and I can go on. So I will stop with this as part of the process and go into details. They need to manage portfolios. They need to do the reviews. Just check the concentration. They need to time to time see whether collateral has value. Then the rating of the customers, whether loans what you have given carry a interest rate which has a good spread or interest expense on deposits. Bad loans are there, you need to do provisioning. All that are to be done by in your credit risk management process. So we also need to look at the recoveries. We need to look at the environment bank we operate and establish our appetite for credit to various industries. Now, risk appetite means the amount of money which we would like to lend to a different industry or different region need to be specified. We also need to manage portfolios based on customer, industry, and geography. There's new thing called stress test to see the possibility of your existing portfolios could move on to non-performing category. We do certain tests, and those tests are called stress tests, or we call it scenario analysis. I will come to that when we move on with the subject. So I gave you this picture about risk management process: identification, measurement, respond, monitor, control, and report. We can attach that to your credit. Also, I explained identification include business development, loan origination, all that. Then which is equal to that. Evaluation is the measurement. Approval is your response. Your monitoring is your credit administration unit will do limit inputs, collateral, execution, all that. Then controls are your reviews. Then report is your management information. So we'll take this process and go one by one. We went on the credit management process, and we did loan origination. Then we came to evaluation. Evaluation, I went through various aspects of retail, SME, and corporate, of identifying the counterparty risk. Now, we are looking at the other side of the coin, which is also need identification, which is concentration risk mainly. So we need to identify exposure to uncertainties. That is, you have different type of facilities given for different industries, different regions, different products. Those will be subject to, based on the, we also call risk factors of the country. And based on that risk factors, you need to actually have your strategies going. So we'll take, for example, if your main line of business will say vehicle imports, customers who are imports vehicle as part of your main credit line of your branch. Now what has happened? Those imports, they are a ban on vehicle imports. As a result, now you don't get business from your existing credit clients. So what do you do now? You can't, you have a branch, we'll say you're generally located in, say, Panchikavat or Maradan area. Your main line of business is imports. If the imports have been stopped, you need to create different strategies. You need to create different operational objectives in order to make money. So you need to first identify the risk involved in your existing clientele, for money what you have already granted. Then you need to apply the same knowledge to see what will be the future like. And these things are done by the risk department, because they need to identify where do you want to put your money, that is risk appetite. How much you want to risk, that is your risk tolerance. CSPM is Credit Standard Policy Manual, Credit Procedure Manual, Lending Guidelines. All these need to be changed if a situation of that nature occurs. That is the identification process which risk management will have to do. Now, measurement. I need you to change this slide slightly, and I will explain what are these. EL stands for exposure or expected loss. EL stands for, you can write down, expected loss. Now, measurement is to actually to identify, you have, when you give a credit, how much money you are going to lose. So if you know how much money you are going to lose, at least you must have collateral to that value for recovery. So identifying the risk and measuring it will enable the bank to take precautions. With these precautions, we call it risk mitigation factors. So risk mitigation can be done only if you know how much you are going to lose. So this particular exercise of calculation of expected loss will, to a certain extent, will enable you to create an understanding of what type of risk mitigation you need to do, whether you need to take collateral, whether you need to take covenants, or you may need to enhance your pricing. That means you need to charge the customer more, the interest rate factor, all will be decided upon on this particular exercise. So we'll take the calculation proper to see expected loss is equal to PD, stands for probability of default. You can write down EL stands for expected loss. The other abbreviation is PD. PD stands for probability of default. And the next abbreviations of 3 letters, EAD, stand for exposure at default. I want you to change this PDG into LGD. LGD, loss given default. So instead of PDG, you write loss given default. That is the recent term what we use rather than PDG. So expected loss could be computed if you know the probability of default, if you know the exposure at the time of default, and you know the loss given default. So how do we, what we trying to achieve here is how much risk is your customer, how much you will be exposed, how much can I recover if default occurs, how can I mitigate this risk through contractual agreements. Contractual agreements here is to take a security, to do a covenant, or take a offer letter sign at a very high interest rate. So I'll explain this in a while. How do you calculate? To do this sort of calculation, actually you need a system. It has to be a computerized system. But I'll explain to you for you to understand how the system works. Uh, Let me go back to the board once again. We'll take, for example, we have set of customers whose credit rating is AA. Now, I told you about internal rating. Internal rating will say if a customer, based on your system calculation, if we obtain between 85 to 90, these customers in your internal rating system will give AA. And we'll say these customers have, we take a type of facility, term loan, duration will say 5 years. So you have set of customers AA, the type of facility is term loan, the duration facility of is 5 years. We'll say you have this AA customers, you have 10 customers who enjoy similar facilities in the last 5 years. Now you have a new customer to add up to the same line of credit. His rating is AA. He also wants a term loan for a period of 5 years. This new customer will say what he wants to borrow is 1 million rupees. Now we want to see the behavior of your last 10 customers. This is where I start. We'll say year 1, year 2, year 3, year 4, year 5. So we are looking at these 10 customers, how they have behaved in the past. To apply the same results to your new customer, to arrive to look at our expected loss. Generally, when you start, these customers will pay. So at least first year, we will not have any NPA. We'll put this 0.5, 1, 1.5, 2. So after first year, if someone has average of these customers have gone, your graph will go here. Then we'll say graph has moved like this. And we'll say after 3 years, we'll have 1%. So when you give a facility to a AA customer over 5-year period, third year we have a average 1% NPA. We'll say after 5 years, we'll have 1.5 NPA. So we'll take a customer who has 1 million and we'll take for example, this customer borrow 1 million and your customer also will go in the same line. We'll say you have given 3 years, he will have 1% of this customer. So at the time, after 3 years, we'll see how much money we are going to lose. We'll take for example at this stage. We divide this amount into 5 in order to arrive at the figures. So first year you will pay 200,000, second year 200,000, third year 200,000. And this is where the default occurs. So already he has paid 1 million minus 0.6 is 0.4 million is the outstanding. I told you EL equals probability of default into exposure at default into loss given default. Now, what is the exposure at default? We got 0.4 million. Now we know the amount, so we know exposure. Probability is 1%. Now there is a chance of 1% losing 0.4 million. This generally is given by your regulator based on this. This is include exposure 0.4 minus value of security. To ease our calculation, I will say you have taken this customer 400,000 worth of security. So you have 400,000 here. Reduce the security by 400,000. This will become 0. So if you know this customer has a probability of 1 and he will default at 3 years, then your exposure will be 400,000. You have taken 400,000 security. You are rest assured that you will have no expected loss because 0 into 0.4 into 1% is also equal to 0. This, I told you, this explanation I can give you in just a plain English, but to compute this sort of a calculation, you need to input your data of your all the loans into a system, and the system needs to segregate internal credit rating given to different customers, type of loans given to customers, the duration, and then based on your NPA records has to be input to arrive at this particular identifying the expected loss. So generally, based on internal rating, you should be able to tell there will be expected loss, and to secure that loss, you need to have some kind of a collateral or arrangement so that bank will not have a credit risk exposure to that particular client. So that's what I call credit risk measurement. Now I'm moving to response. You know, response is its approval or decline. So if facilities complied with the lending guidelines on your credit policy or the procedure manual, you see whether credit risk department need to see whether if there's a facility given to a politically exposed persons, if your bank's policy manual says all the political exposed people's facility has to be approved by board, you just have to mention that this facility need to be taken into the board level for approval. So similarly, if you have certain restrictions on durations of letter of credit to be established, if a branch has established a letter of credit for 6 months, though it is within the limit of branch manager, probably it might go to higher level because of the duration. So all these need to be checked by the credit risk department. Is the facility within the single borrower related party limits, which I will come to you. Is credit rating carried out and the facility fall within the investment grade? I told you facilities above 60 points will have B and above, and anything below B will be C. So if it is non-investment grade, facility need to be declined. Does the capital charge on proposed facilities acceptable? I told you this about earlier when I explained to you the credit process. The bank's balance sheet amount of money you need to allocate for credit based on risk weightage is called what is called credit capital. So the counterpart risk, qualitative, quantitative aspects have been adequately analyzed. Risk department also looked at your ratio calculation. That's what it says. Counterparty's risk of qualitative and quantitative aspects have been analyzed. Does the pricing reflects riskiness and adequate? Bank has a interest rates are listed on a sheet, but however, if your riskiness is high, as a credit analyst, you need to quote a high interest rate for that customer. That's why on the basis of credit cards, we have high interest rates compared to housing. Has the structure based on customer cash flows in the form of appropriate product and channel? Now, we looked at trade finance. You can remember, I put LC limit within which I put a revolving import limit for importer. So that is what is important. We call it the structuring of facilities. Similarly, the export customer will have a high export bill purchase facility within which only he will have a packing credit line. And you can have an overdraft within which, or you can have an open overdraft for customers' working capital. This, given the structure of a customer, is very important based on his cash flows. That means you give a revolving import loans, you don't give a revolving import loans for 1 year. You give a revolving import loans for generally for 90 days because you know the goods that are being imported are for sale. So any proceeds of this sale need to go into settle this revolving import loan. So based on cash flow, you give the facility. Appropriateness of covenants and collaterals to mitigate risk. I told you sometimes risk can be mitigated through price, covenants, and collateral. So you need to take appropriate. That means if you take a housing loan, you need to take a mortgage on the house, which is been funded for. You need to take a mortgage protection on the same line. You need to take insurance on the same house. Those are the appropriateness. If the answers of most questions are yes, risk will approve the facility. So that's the response. Now, some of the things what we looked at there is called regulatory requirements. I said it need to be within the single borrow limit. Now, single borrow limit is based on your equity, the bank's equity. I told you our balance sheet consists of current assets plus fixed assets will give you the total assets. On the liability side, I told you we have current liabilities, which are depositors' money. Then we have long-term liabilities, debentures. Then we also have shareholders' money, and reserves and accumulated profit are also in the equity section. So bank, that's belong to shareholders. So single borrow limit is a concept which central bank wants all the banks to follow, that they cannot lend to a single customer more than 30% of their capital. If it's a single customer, if it's a group of customers, you can give only 33% of capital. Now, let me explain this to you in a little bit of detail. We'll say we have two customers, say A and B. Bank has a, we'll say, equity of 10 billion rupees. Customer A wants 4 billion. Customer B also wants 4 billion. We get as collateral, we get 1 billion cash. We get 0.5 billion cash. From A, we get only this. B, we get property mortgage for 3.5 billion. So here, 3 billion is clean. This total is 2 billion secured. Now my question is maximum amount of accommodation. So I put this illustration to you, or in simple language, we call it a single borrow limit. I told you bank has a limitation that they have only 10 billion capital. According to the central bank governing rule, you can lend only 30% of your capital. 30% of 10 billion is 3 billion. Now both customers are asking 4 billion. Can you give? But there is a condition here, net of cash and various other securities. So this customer, you are 1 billion cash. So now he is entitled to 3 billion. So this customer can be given. This customer gives cash only 0.5 billion, rest is property mortgage. So his exposure is 3.5 billion secured by a property. He cannot be accommodated under single borrow limit because bank has a regulation of giving only 30%. You see, now how do you accommodate customer B? This guy is giving us a security and good facility. If you are a bank, I'm sure rather than taking this loan, though he is entitled to it as per single borrow limit, you would like to take this loan, which has a fully secured facility. But however, restrictions are there on the regulator to lend 3.5 billion based on your single borrow limit of your capital. Bank won't lose this sort of customers. They go for something called syndication. That means they will invite another bank and say, we have evaluated this customer and he is creditworthy. We have a limit. They won't, bank will not say that we have a limitation, but we would like to, offer part of the loan to you if you are willing. And bank who has this customer will be a leading bank. They will invite another bank. And leading bank will charge for evaluation and other things a certain percentage, and then part of that loan can be taken by another bank. So customer will get the facility. Both banks will share the profits. That's what we call syndication. So maximum amount of accommodation, or call it MAA, is in colloquial language we call single borrow limits, is a requirement by the regulator to limit large exposures. That means your exposure to a single client. So if he fails, that there will be a big impact on your NPA. Therefore, to avoid that, that regulation has come. So I'm going back to my slide. Second one is related party. Now, once again, I need to explain to you who is related party. This is the maximum amount of accommodation. I'm skipping this because this classification of advances, this is based on the duration of the facility. But however, now since the introduction of new accounting system, international financial standard reporting, central bank is maybe they have already decided to do away with this in classification of advances. Therefore, I'm moving out of this and going to blend into directors. It is related party. Related party, first, let me see who is related party. Related parties, all these banks, banks have subsidiaries. Most of the banks have another finance company or a leasing company attached to it, 100% funded by the bank. We call it associate company. Some banks will have their building the building what they occupy is belongs to another company. That company is 100% owned by the bank, and bank pays the rent. These are for tax concession and various other aspects. So any subsidiary or associate company we call it a related party. So there are guidelines given by central bank if you want to lend it to a related party. Any of the directors or key management personnel is a related party. Now, key management personnel, you need to understand your hierarchy in your bank. Generally, your CEO and the corporate management, DGMs, AGMs are hierarchies of your bank. The close relation of the directors or key management person, that means the wife of director or a key management person will fall into this category. Shareholder owning material interest. Material interest is about 10%. So any shareholder who is owning more than 10% also will fall into the related party category. Any concern in which of the bank's directors or close relations of any other bank's directors, any of the bank's directors or any of its material shareholders has a substantial interest. Now, this need to understand in little bit complicated. Once again, I need to go to the board. this Sri Lankan business generally, you know, you have group of companies, we have conglomerates, we have these groups. Some groups are affiliated to banks also. So we'll take, you have a bank A, we have 3 companies who have funded the share capital, we'll say so they have 3 companies who have funded this bank by way of shareholders, and so they have directors representing in the bank in the basis of their shareholding. Now we'll take for example, so these directors we have 2 directors from company B. Company B has 3 more companies. We say EFG. B has funded 100% of this company. He has funded 20% of this company. He has funded 8% of this company. Now, all these directors who represent are related parties because as part of our related party categorization, they are all directors. So, BCD, these 3 companies are related parties. So, when they borrow, the related party rules will apply to them. But D has 3 other companies, EFG. B has funded 100% of E, so E also become a related party. B has funded F by 20%. We said material interest is 10%. So if he has exceed material interest, F also become a related party. But D has funded 8% of G. Now these 5 companies, if they come to borrow money, they are called related parties. This company is not a related party as a result of the funding by B is only 8%, which is not material interest. Therefore, G will go as a normal customer, but you know, I would call him a connected party. But not fall within the related party categorization. That's what you need to understand. So related parties we'll see now. That is the categorization. The principle he applies, the core principle state that extension of credit to individual or firms connected to the banks through ownership and through the ability to exert direct or indirect control, if not properly controlled, could lead to significant problems because of creditworthiness of the borrower is not always made objectively as such. Now, these 5 companies which I explained to you are related parties. You know, their directors are represented in our board. So if a facility comes for any of these companies, there's an influence. And your credit officers may get subject to that influence. As a result, you will not do a proper evaluation. You will not ask the same questions what you ask from normal customer. And you will not be very strict in applying all the things what you have discussed, analyzing of credit, evaluation, asking for collateral, covenants. increase in the price, they also will demand very low interest rate. As a result, therefore, central bank request such facilities need to be approved by the board of directors, and board of directors must have 2/3 of directors present when they approve it. That means 2/3 of directors must approve this facility. The director concern of to whose company has been approved, list been sought, need to be out of the board at the time of this facility has been approved. So you see very strict regulations central bank has applied. They also given little further, they have gone and said, these are the securities what you can take. When you take a cash deposit, only you can consider only 90%. To take an insurance policy, you can consider only 75%. If you take a property, you can only consider 60% of the value. I know some banks, even normal customers, they can go up to 75%. Then if you take quoted companies shares, you can only consider 50% of that. Stock in trade, 30%. Pledge, non-perishables at 40%. That is related party. This area, these slides is about considering capital adequacy, which is not part of it, but I explained to you earlier that risk-weighted assets are being taken from the credit portfolio to evaluate the capital requirement of the bank. That is, we call is based on Basel II calculations. Now Basel III also has come. So I will skip this. It's not meant in the program. Now I want to really concentrate on practical aspects of how do you evaluate your branch or your bank's portfolios. Here I have taken as an overall this calculation done somewhere in just imaginary calculation. I have put the dates as 2015. 6 years have been passed. So don't worry about the date. You need to worry about the timing, the quarter. Now this particular bank has a 98 billion as at September 30th of that day. And I have put PLAs. Out of this 98 million, 75 billion is being paid very regularly. That means not even a single day these customers have defaulted. We also have something called overdues. Overdues is up to 90 days, customer has not paid. That total amount includes 15 billion. And over 90 days, we generally call it non-performing category, are 8 billion. So this is how I analyze the portfolio of 98 billion of a bank into 3 areas of performing, overdue, and NPA. Performing, you don't have to worry much because these customers, it seems that customers are not running the risk of counterparty. They have ample profits. As a result, they pay you. Overdue customers are not bankrupt, but they have difficulties. That's where you need monitoring by the bank, and also sometimes if the things get worse, they get into non-performing category. Non-performing category need recovery action. So different type of initiatives has to be based on these type of portfolios. So you do this on a quarterly basis and see how you get improved based on the strategies what you take. That is part of risk management process. So second quarter ending 30th of December, they have increased their lending by 2 billion, and 2 billion has gone to NPA. So it's not a very healthy situation. Then on the next year, the first quarter, they have increased to 105. So 105, that means 5 billion lending has been gone in. You can see they have reduced the NPA by 1 billion from December. That means that's good. But overdues have gone by 2 billion. So only 4 billion has been added up to your performing. Still not very good. On June, facilities have been increased to 115. Another 10 billion has been added. Out of that 10 billion also, only 5 billion has gone to performing. And you can see there's a decrease in the overdue, but increase in NPA. So these are the quarterly analysis of your entire bank's portfolio. Now we'll see how you segregate this onto industries. Now central bank has given these categorizations. We have agriculture and fishing. We have manufacturing. We have tourism. We have transport. We have construction. We have traders. All those import, export will go into these. New economy. I need to, I think, give explanation what is new economy. New economy is, in other words, we call it a dot-com company. Software companies, computer-related technological companies are all there in the new economy. Then we have financial and business services. We have infrastructure facilities. Then we have other services. Then we have other customers. All the retail customers will fall into this other customer category. They enjoy credit card, pawning, and any other type of retail lending. Other services are, we have, all these are kind of businesses provide goods. Services means we have doctors, engineers, accountants, so they will fall into the other service category. Central bank has a requirement that banks need to lend at least 10% to agriculture. So if you have 100 billion, this bank has complied to that 10% requirement. Because central bank thinks, we need to understand Sri Lanka is a agricultural country where we need to be self-sufficient in our products, food. As a result, central bank also imposed the bank certain conditions to lend to agriculture. Now, what you need here is, generally, risk department also participate in preparation of budgets. All the banks prepare a budget somewhere in November for the following year. Now, in 2017, this bank has prepared a budget which has a lending portfolio of 100 billion. And the budget forecast is to increase the lending by 20%. That is, it will go into 120. Now, risk department need to match that increase and allocate certain prudential limit for the categories of the central bank, what they have done. So you can see immediately they have put agriculture and fishing from 10 to 12. That's a regulatory requirement because at least 10% has to be lent to agriculture and fishing. So that has been taken care of. Manufacturing has gone by 6 to 7%. Generally, this is another area which most of the SMEs are manufacturing certain things, so banks need to expand on that. This was done in 2018, which was a booming period for tourism. So you can see the budget. Tourism from 5 billion to 10 billion increase being forecasted. But if you have done this in 2020 or 19, probably you may keep that 5 billion as it is, or even recommend a reduction. Transport also go along with tourism, so they have increased by 2. Construction, there was a booming period during that time for apartments building, but I think now it has slowed down. So construction also has gone up by 5 billion. Traders, generally when the economy is doing well, trade get expanded, and as a result, this bank also allocated additional 3 billion to trade. New economy is another area of development, 1 to 2. Financial services, they are kept at the same level. These are the borrowings by other finance companies from banks. You know, though we think, so if you look at, analyze this particular portfolio, you may find sometimes there's no NPA in this. However, funding another financial institution, there's a certain amount of risk, because you can see in recent times, we have certain finance companies who have gone down. And if you have lent to one of them, and those lendings are generally large and also mostly on clean basis. So as a result, there is a chance that bank can lose. So probably the risk department would have thought our exposure of 10 billion to the same sector which we also operate, and they are our competitors, we could do our own lending rather than, funding them. As a result, they are kept at that 10. Infrastructure also, they have put as same level. Probably mainly infrastructure generally is funded by aid by the government. So probably this bank would have been a private bank. They would have thought this area where, funds will be sought for very long period, and bank may not be able to, canvas deposit for very long period. So they may not have funds to accommodate this type of large loans even for a very long period. So they have kept at the same level. Other services, they have improved by 1, because doctors may establish clinics, lawyers will set up their consultation facilities, accountants will expand their audit facilities. So all that, they have expected another 1 on that. Credit card, there's expansion, pawning has kept at the same level, other facilities at the same level. So when you forecast the budget based on industry, different industry portfolios, threshold limits, the maximum limit what they can lend to a particular industry has been earmarked in the budget itself. So the next year, the lending guidelines will, lending limits will apply these industry limits. So the concentration will get covered, because you will not lend more than that limit what is being set. You will not lend, we'll say, construction more than 25 billion in the following year. So this is what we call industry classification, and the limit set on those lending to that particular industry. That way we could minimize our concentration risk, because we have industry limits. Now I take one product. After this, I will have a break. We will do some more products, and then after the interval, there are 2 papers being given. I would like to tackle the 2 questions, what is mentioned in those papers, so that you will have a good understanding of overall studies what you have done about counterparty risk and concentration risk, and in overall the credit risk management. So we'll take this one, we'll say on a particular date. This was taken in these banks in 2017. They had 40 billion worth of overdrafts. In overdraft is a product. Generally, bank will approve a limit, and most of the banks would advise the branches to maintain the customer's overdraft within that limit. However, due to various transactions and due to various requirements of the client, this limit gets sometimes violated or exceeded, and sometimes before even setting up the limit, the facilities will be exposed, because current account of a bank can be overdrawn by the bank to allow customers to draw more money. So this bank has a total overdraft of 40 billion. 29 billion will remain within the approved limits. We have another 8 billion which have gone exceeding the approved limits. We also have another quantum which is 3 billion which has no limits. So why I have categorized into these three categories of this 40 billion is to identify the riskiness of this portfolio, of this product. So 29 billion, we can safely say our risk has been covered because you have given approval. Approvals have been given based on evaluation of the customer proper, taking into securities, all that. If you have exceeded the limits, those customers are enjoying credit facilities, but probably these excesses are being granted based on additional securities you have, or part of the loans what they have taken have been repaid, has been accommodated under excess. So still the risk is there, but risk is not big as the third category, which is no limits. That means probably these customers might not have facilities at all. They have been considered on a very casual basis, and this total is a little bit of high risk exposure. So total excesses are 11 billion, but out of which 3 billion, which is of a high risk. So risk department need to monitor this and advise the business units to recover this money, which have close monitoring mechanism to recover this money. So I will stop at this moment now. We have pawning portfolio to discuss, leasing portfolio to discuss. We need to do a little bit of risk stress test on credit. Then we also need to analyze certain indicators of key risk, and then we conclude our session with, after another 4 slides, then we tackle two past papers, 2 questions from past papers for you to give you a better understanding of what is this credit risk management module of your credit management diploma. So we'll take a break and we'll join in, we'll say 20 minutes to cover these 4 slides and questions. So this particular bank will say total pawn portfolio is 10 billion. We can categorize the pawning into performing. That means pawning is a different type of facility which come under different act, pawning act. That means you give a grant against gold. It's a loan, repayable anytime during the course of the year. So you cannot recall the facility or you cannot demand repayment until 1 year is through. So any pawning facilities within that 1 year remain performing. And any facility which has gone after 1 year, but you haven't given the notice for auctioning, we call it overdue. But if you have done the notice auctioning, and if a bank has failed to collect the money at the auction for the particular article due to various reasons, the value what you got is less than the total outstanding, whatever, then after the auction is over and still you are holding the gold without recovery, we call it non-performing. So pawning at the moment, it's a very lucrative business, but 2012-13, all the banks suffered heavy losses on this portfolio due to market price of the gold came down, because now you can see nowadays a sovereign is trading something like 90,000, 98 in a 24 karat item, and banks are giving very high value loan to value ratio. That means sometimes you can give, say, up to 80,000 or even little more. If you give a 80,000 loan, which is going to be there for 12 months, we'll say at 18%, we'll add the interest to something like, it will come to about 95,000. So if the value of the sovereign is 98,000, if it remains same, customer will compel to somehow pay money and redeem the gold, because the value of that particular gold is still high in the market. Just imagine the world market price, if it comes down, local prices also will come down in gold. In 2013, generally gold is valued at 1 ounce. In US dollar terms, it was about 1,200. In 2013, it came down to about 960. 1,200 level, convert to rupee, pound, one sovereign is about 40,000. When it came down to 960, it is about 30,000. So what happened is, there is a 10,000 reduction in the market price for a sovereign. And if you have given 30,000 advance, and if you added interest to that, it will work out to about 35 to 36. So what you can get for a 36,000 total loan and interest outstanding, if you can get only 30,000 when you auction it, banks had a loss. So in 2013, banks suffered huge losses on this portfolio. Therefore, you need to actually, in this portfolio, you have got to be very careful to monitor the world market price, adjust the loan to value ratio accordingly, and also to be careful about dud articles. You need to see your gold items have been taken as collateral in this portfolio. So risks are there in this portfolio also. Leasing portfolio, nowadays, there's a huge restriction, because previously the leases are being granted 100%. And especially if you give machinery, that can be shifted from one place to the other. And only you register it, but you may not be able to get the machinery at the same value due to depreciation. Vehicles, of course, you register with RME and you have the right to repossess, because banks will have the absolute ownership. So those are the risks involved in the leasing. Stress testing is a process. Now, this we attach to some kind of a scenario. Now we'll take, for example, COVID-19. But COVID-19 is something which has happened, right? And when this happened, we never had initial understanding of what will happen to credit portfolio of the banks. If we had done stress testing, moment it happened in China in 2019 November, if we had done a stress test, we could have thought this particular epidemic will hit Sri Lanka. And if we have thought that way, and if we have done a stress test to see how it will affect our credit portfolios in banks, we would have predicted that NPAs are going to increase. As a result, provisioning will increase and banks' profitability will go down. And when the profitability go down, your capital adequacy will go down, your liquidity will also go down. This is what is stress testing is about. That is to identify a scenario of a future event and see how that will affect your credit portfolio or a product portfolio, and calculate in such a way that additional provisioning, additional interest in suspensing will create a loss, and that loss is going to affect your current year's profitability, capital adequacy, and liquidity. That is what we call stress testing, and this is a little bit of advanced technique we do for in risk management processes, but credit management I just indicated to you because this will also be part and parcel of credit risk management process, because stress testing is to be done according to the regulators. I want to give some indicators of credit risk now, because when you're reporting to your senior management, you don't just say bank is now credit risk is very high. You won't say like that. You have to give some figures. That figures will come by way of key credit risk indicators. Now, key credit risk indicators include gross non-performing advances ratio, net non-performing advances ratio, provision cover, open credit, and overdue advances. Now I am going to go back. Can you see the screen again? I will erase this.
I can't see the slides.
Can you see the board?
Yes, you can see the board.
Okay, slides I'll show you a little later. I just want to work on the key risk indicators, key credit risk indicators. We call it KCRI. First one is gross NPA. Now, NPA is total non-performing advances divided by total advances into 100 is a NPA ratio. We'll say your bank has 100 billion loans, 5 billion are non-performing advances. So we say your non-performing ratio is 5%. So when you indicate, when you give reporting, you give to your board as key credit risk indicators. If someone asks you what is your risk in your credit, this is one of the key indicators what you provide. This includes total NPA. Now this NPA is including now I'll explain what is this IIS is. IIS is interest in suspense. Now generally when your overdraft is non-performing, what you do is, or any loan which is non-performing for 3 months, you initially suspend the interest what you get from this particular facility. And this suspension of interest, that means accrued interest on those facilities will be not taken into your profits. Instead, you put into a different account under interest in suspense. That means you lose those profitability out of those facilities when they become NPA. After 6 months, not only you have suspended the interest, but you need to provide 20% of that total outstanding a provision. Provision means you debit your P&L and credit a provision account. That means not only you are getting new income, but also you have to hit your profit and loss, making a loss situation from the existing and create a provision for that facility. Now, this total NPA include the capital outstanding, interest in suspense outstanding, and the provisions you have already made for this. It's in a different account. But if you reduce your NPA, IIS plus provision, we call it net NPA. This net NPA divided by total loans into 100 will give you a net NPA ratio. So this is an indication that though banks originally 5%, but if your interest in suspense is, we'll say, 500,000 plus provision another 1.5 million. So out of 5 billion, 2 billion you have already provided. So the net NPA becomes 3%. So this will give a buffer that even if these loans has to be written off, what you have to be write off is net NPA. You have already provided for the balance. So this is net NPA. Other one is called provision cover. Now here I said you have a 5 billion loan, you have provided 1.5 billion. Provision cover means total provision what you have provided divided by NPA into 100. So I put it to figures 1.5 divided by 5 into 100. How much? You have 5 billion. You have 1.5 billion. So you have a provision cover of 30%. Generally, higher the provision cover, lesser the credit risk. Why I say is this: if you have to write off these loans, 5 billion, provision will take care of 1.5 billion. So generally, we say more than 30% provision cover is good enough to cover credit risk. Now I may have to go to slides again. Can you see it again? Can you see the slide?
Yes, I can see.
Yeah. So we have given you gross non-performing explanation, net non-performing. Open credit cover is your net NPA you divide by your equity capital. That means you want to see that net NPA is 3.5. If you here we took at 3, yeah. How much capital you have in order to pay for your NPA losses. Higher the capital you have, risk is less. If you are a bank with a very large capital, you can afford to have NPA because some of the NPA even cover your credit losses with your shareholders' money. In case bank became bankrupt, shareholders' money can be accommodated for credit losses. We call this open credit cover. Calculations come from net NPA divided by equity capital. Overdue advances, if you can go back, I will go back and show you our credit quality analysis. I told you performing loans, overdue loans, and NPA loans. Now, this overdue position is loans and advances which are not NPA, but they are not paid on time, but less than 90 days old. There is a certain risk. So it's a risk indicator. And as a result, we show as a ratio. We take total overdues divided by your performing advances and make it a ratio. Then you will understand part of your performing loans, though you say you are performing, are subject to risk because they are up to 90 days overdue. So these are the 5 key risk indicators we generally report to the board of directors for them to identify the overall position of credit in the bank. But this is not sufficient. This is only the key credit risk indicators. But you can give large exposure. How the large exposure, that is 10 big customers who have taken money and their performance. You can give a report of related party. You can give a report of adherence to all directions. That means within agriculture, if they are asking you to maintain 10%, you can give that total amount of money being lent to agriculture. So as a result, you are complied to central. These are some of the information you can provide to the board of directors meeting by the risk department. Especially these 5 ratios are important for them to identify the credit risk of the bank. Mainly the gross NPA ratio is an indicator. All the, not only the management, even outside the management is worried about before they invest money in the bank. Especially if you have a debenture issue, the investors will ask, what is your NPA ratio? I think after this COVID-19, most of the banks are showing a little higher NPA ratios because most of the businesses are finding it difficult to make profits. As a result, repayments have been weakened and NPAs have been increased. Generally, prior to COVID, NPA ratios were something like 2 to 3%. Now I think Some banks even report more over 5%. So it's a credit risk has increased due to this epidemic. So that's all what I have to say about our course. Now I will take this opportunity to go to 2 questions. Actually, question paper, if you go through it, I have a very small portion in the question paper. I think my question comes in the section there are 3 sections. In this section 2, I'll go to the other paper. I think I can't find my question. Yeah, question number 5. If you read this, it's COVID-19 impact the economies of all affected countries, including Sri Lanka. We had a lockdown period of 2 months. This is the first wave of COVID. And thereafter, businesses were conducted under strict health regulations. Central Bank of Sri Lanka reduced the interest rates and requested all commercial banks to allow longer repayment period on loans, leases, and other advances. You are a credit manager attached to a licensed commercial bank in Habarana with a loan portfolio of 500 million. Now you need to note down some of these figures which I mentioned. The first statement is COVID-19. So you know what it is, what has happened in the COVID-19. When you read this, you will understand businesses have gone through difficult times. Central Bank has given relief. Those reliefs will allow banks to extend the and reschedule facilities. So that is one part of it, and Central Bank is willing to fund a loan at a lower rate, so that's a refinance arrangement. So what the regulator wants is they give you a certain amount of relief in order to come out of this situation. That relief has to be passed on to your credit customers. Now we look at the real situation. You are a credit manager attached to a licensed commercial bank in Habarana with a loan portfolio of 500 million. So now we'll note down Your loan portfolio is 500 million. Your branch is in Habaran. What does that indicate? You are in a place which is a tourist hotspot. As your location is a tourist hotspot, your exposure to tourism is 40% of your total loan portfolio. Now, they say you have industry categorization, and in this, you have tourism. 40% of your total loan portfolio is given to tourism. Now, what is 40% of this? So 200 million out of 500 million, 10% is 50 and 40% is 200 million is given to tourism. Branch has an NPA of 4%. So your NPA is 4%. So 4% of 500 we are so used to calculations, so let me put my calculator and give you the correct figures. In the meantime, you can also do the calculations. So your 500 million is your portfolio. 40% is given to tourism. 500 is your portfolio. 4%, that is 20 million, is your NPA. Then it says you expect further 20% of loans and advances granted to tourism will be classified as NPA within 2 months. So you expect another 20% to go down. Another 20% is how much? Another 100 million will go down in next 2 months. So what will happen? You have 20 million. Your NPA will be added by another 100 million. So your NPA ratio will go to 120 divided by 500 into 100, which is you expect another further 20% of loans and advances not will be classified as NPA in 2 months. So now your NPA become 24%. Compute your branch NPA ratio if further advances in the tourism sector gets classified into NPA. So the first answer is this. If you are to avoid such high NPA, what risk mitigation techniques would you initiate? So the first question is very easy. The answer A is this. Now you need to understand a little bit of what we have studied. Now you remember we talk about credit risk divided into 2 areas. We said counterparty risk, concentration risk. Here this is a case where both involved, because you have your branches in Habaran, mainly businesses are related to tourism. So you have funded about 40% of your funds for tourist sector. Now you have been asked, you have been hit now. And as a result, your NPA has gone up by from 4% to it has gone to 24% because of the epidemic which has affected the particular industry. So these industries being mainly tourism. So tourism is a hit industry. So you need to reduce your exposure to tourism industry and to increase your other portfolio in order to avoid NPA. That is the first answer I can give you, because NPA ratio is work out your total NPA divided by your total advances. So if your tourism industry is doing bad, putting money once again into the same industry will create more NPAs, and therefore your NPA mitigation will not take place. So you need to, in credit terms, we say you need to diversify. So you need to find customers who are engaged in other areas of businesses and make loans to them in order to mitigate your high risk area of high NPA. Then also you need to understand you are exposed by 200 million to these customers. This 200 million, out of this 200 million, now they say, yes, out of this 200 million, now, sorry, 100 million will come as NPA. When this 200 million was there, only 4% of which is 20 million is NPA. But because of the situation, another 100 million out of this 200 million has come here. So about 120 out of 200 million is bad. So your tourism has affected to the great extent that almost 60% of your facilities given to tourism has gone bad. But another 80% is performing. Now this 60% of 120, you need to initiate recovery action. How do you mitigate or to bring your NPA lower is to recover, which has gone bad. So another second mitigation, first mitigation action is diversify. Second is recover what has already gone to your NPA. Then we have discussed two areas. That is, if you have to avoid high risk NPA, two techniques. One is diversify. Second technique is initiate recovery. Recovery is part and parcel of your credit process. Third one is now this sector you can't completely ignore because that area is very lucrative for this type of business. But now you need to be careful. There will be situations where, existing customers asking for reschedulements, existing customers asking for additional facilities to move into from foreign tourists to local tourists. So that also you need to take. So you also need to mindful that you can't completely stop this business. You need to manage the business. You need to manage the risk associated with the particular business industry. So what you need is, you need to get approval. Sometimes I think reschedulements have been approved, refinance been approved for these loans. So immediately you can apply for those schemes and provide a longer period for NPA customers to pay and convert their NPAs back into performing. So government initiatives, bank need to take into consideration and apply immediately for those relief granted for affected customers. And those who are unable to do it, you need to initiate recovery. Then on the counterpart risk side, any new proposals, you can apply what we have been taught, how to avoid counterparty risk by proper loan origination, proper evaluation, then very concerted monitoring are third areas of how to avoid risk mitigation. Then also finally I would go into main risk mitigation aspect is to have some kind of collateral. You can have collateral, you can have covenants, you can have increase price for those risky customers, so you recover your money accordingly. So risk mitigation comes from diversification, then recovery action, then applying strict credit evaluation techniques for new facilities, and also obtaining valued collateral, applying covenants, and arranging the price to determine high risk loans to be charged high in order to. Those are some kind of mitigation techniques you can apply. Now those that will have 7 marks. The first one was so easy. You have got so with these 4 you have already got 13 marks out of 20. The last question, last part of the question is, despite downtrend in the sector, you have been requested to evaluate new proposal to finance purchase of a medium-sized hotel which has put up for sale in the area. What risk factors would you consider in your risk analysis if you decide to respond positively? Or how do you mitigate credit risk? Now you have been given a real life situation. When things affected by outside epidemic, most hotels are not going to be closed. The industry is affected, but you know, there are certain customers whose credibility is, whose asset base are very high. They don't want to get out from the industry that soon. This will be opportunity for them to buy some other affected hotels and attach to their portfolio so that they will make more money when things get all right. So you will get this sort of rare opportunity to provide to customers additional facilities to purchase hotels who have been affected because then the prices are down. But what you will achieve as a bank is 2 things. Just imagine this, the hotel what they are going to buy is a facility which you have already given, which has been going into NPA. So you get an opportunity to recover your NPA and improve your NPA position. Second one, you are changing the customer from customer who's been affected to a customer who's capable of repaying you a new loan. What you need to decide is to get a customer who has a different diversified business interest. That means though the tourism sector is affected, his other businesses are making money. So he may be able to pay the loan from the proceeds of or the profits of other businesses. So what you need to in this is you have got opportunity for a customer who has come to buy a medium-sized hotel. Risk factors what you consider is you take the hotel as per se, the hotel which is for sale, which is not making money. So there's no point analyzing financials of that hotel last 3 years, because probably the last 2 years hotel we have done well. This year it is not doing well. So there's opportunity once the industry improves that they can start well. Until such time, you need to bear that this customer need to pay you when you give a loan. So you need to verify whether he has other businesses. Risk factors are this loan also can go down into the NPA. To avoid that, you need to get a counterparty who has other income, who has sound financial background for you to pay from profits of his other businesses. Um, This is an area how you respond to this, but also bear in mind you need, because the industry is bad, you need to fully collateralize this facility. Take not only if the hotel is being valued at that price, and you can take a mortgage, or you can take the director's personal guarantee to secure further this facility. So you can increase the collateral cover, you can increase the covenant, saying that if hotel is not making money, that money made out of other areas would be utilized to repay this loan. So that kind of arrangements you can make it. You can take overall customers account, that is a group account, and do analysis of his credit worthiness. So that's the answer you can give to the third part. So what we have covered is, we have covered one key risk indicator, that is your NPA ratio. We have covered certain techniques which we use to avoid going into NPA, that is risk mitigation. Risk mitigations are, I told you initially, taking collateral, covenants, and price. Diversification, that diversification is to reduce the concentration to one particular industry. And then you also said you can use your credit management, the credit management process, that is to do the evaluations right, do the origination right, do the monitoring right, to avoid further NPA. So we have covered one question, which is, I think, very recent one. I'll go into the other one. Let me find out what is the answer. Unfortunately, section 3 is not here in this particular question. There's only up to question number 3. I think question number 5 was the risk related one, which is not listed in today's presentation. So I think I may not be able to take that. To conclude our session, we have done one question. I will do a small summary of important slides for you to look for. You need to understand this credit process well, because credit risk can be mitigated if you do the process right. So this slide, if you can remember these slides and in your answers, if you can put these slides, you will get the highest marks, because especially credit risk, counterparty risk can be done with credit management. Mainly credit evaluation will reduce the counterparty risk. So risk mitigation can come from business unit. On the other side, mainly the concentration risk can be reduced from credit risk management side, because portfolio analysis will allow threshold limits for different industries. That is called diversification. So this slide is an important one. If you can list this in your answers, then if it comes to retail credit, I like this 5 C's of good credit to do it, but not for any other facilities. And SME, I told 2 words. SMEs generally financials are not correct. It is your decision to customers management versus financial means. Don't rely on financial management alone. You need to look at the customers' track record, business visits, all that to be taken into consideration if you are doing SME credit evaluation. Then in this, we looked at 3 ratios of profitability. All depends on the business modules of those customers in the corporate analysis. And this slide is important. One of the key risk mitigation technique is to take covenants. So pledge or promise between 2 parties. That means you put certain conditions. So the borrower will not be very fancy in his expenditures. Now it's say, if you say you arrange the customer to maintain liquid ratio is current ratio is 2:1, will restrict him to maintain asset base. If you restrict debt equity ratio of a customer, it will maintain, that will stop his additional borrowing. Question එකලා මේ අනිත් එකේ පොඩි ප්‍රශ්නයක් තියෙනවා. මේක මගේ question එක නෑ. section 2යි තියෙන්නේ.
ඔව් අනිත් මේ වෙනම දැම්මනේ paper 2 paper අනිත් paper එකට යනවා.
හරි ඒකේ මම එක paper එක දාලා paper එක දාලා එහෙනම් මම එක්කලා හරි මේක හරි
විදිය පාර paper එක ඔය format එකට ගියේ එකම paper එක මේක.
right.
Ratios වෙනම ගියා මේක වෙනම ගියා.
Right. It is same question paper that I was searching for 2 questions, but it is 1 paper, so we have covered that. Based on that, now I'm going through a revision. Risk mitigation through covenants, collateral, and price is an important slide for you to look at, because most of the questions will come like, also to mention the risk mitigation methods available to, avoid the situation. So you can touch these covenants, collateral, and price. Further explanation are given on covenants. Collateral, further explanation given. That means you need to take proper collateral, proper documents. Also, you need to register those collateral in proper registrars in order to a bank to have hold on the customer. Then this I also looked at a question might come from specialized credit area, which I explained to you: LC, LCU, DP, DA, open credit, also advanced payment. So methods were discussed, and also in the slides, the risk are also mentioned, including the country risk and the fraud risk. Apart from that, this slide is important because this will give the industry types and kind of threshold what you make on this total portfolio will be a portfolio limit, and the portfolio limits will really manage the concentration risk. I think those are the key areas what you have to look for. I think I have only one question out of the subject. So I have given, I think, 4 or 5 key areas for you to understand, including this this one, key risk indicators. So questions will come from key risk indicators, industry portfolios, credit process, and mitigation methods available are the 4 areas what this one question which will come in your paper will cover. So I want you to study those areas well, and also to first read the question and understand it. Read it 2 or 3 times, because I generally touch on a real-time situation. So last question paper, that was the last question paper we have given for last batch. I went to the first round of COVID and touched that area, and it's a real type of situation. And I think this time also, I think COVID prevails, and I will not touch the COVID, but you know, I will touch a type of industry and take an example, and for you to do a little bit of calculation also. Now see, the first 6 points were done on just a mere percentage calculation. So I think bankers work with figures. So I will also put some figures in the question, and the first 6 points can be earned in a matter of no time. Then the other 2 will need little bit of your creativity and understanding of the subject for you to answer. So I hope you will tackle my question and answer give me the answers even in point form. I don't want big essays, but if you can indicate some of the diagrams which I have mentioned in my slides, will give me a understanding that you have understood the subject matter proper. So then you will get the full marks. So thank you very much, and I wish you all the best in your exam, and hope you have learned something new in the credit area. It's a very important area for a banker, especially managing credit risk. Thank you very much, and all the best. I conclude today's session with this. Anything you want to ask, you can ask me now. Any questions you have? No questions? If you need any further clarifications about the subject, if you don't understand while you are studying it, I can give my email address on the board. all simple, C Nanakar 6457 at gmail.com. All simple, though I started with a capital E, all simple. Right. I'm going to conclude and stop sharing now.
Sir, can I ask you one question?
Yeah, sure.
This is in generally this tourism sector is still is in the risky sector.
Yeah.
Are there any, apart from this moratorium extended up to 2021 September for further 6 months, are there any other government granted facilities to smoothening their operations towards the business, towards the loan repayment?
As far as I know, I don't think yet. Only what they have given this moratorium, plus, there was a loan scheme to revive, refinance scheme to, allow further facilities.
Yeah.
Apart from that, at the moment, there's none. So bank need to be careful about the sector until it's further established. So you have to have a little bit red alert on this industry sector.
Yes, but still we are very much on the side of rescheduling, or either restructuring also.
Yeah.
The thing is, cash flow is a concern. So
yeah. So you need there is a little bit of diversification, because at this moment we have these entrepreneurs who are who have other businesses, who have very diversified industries, but they have other businesses to pay you back, and those customers might take the opportunity, take this as an opportunity, and come for new facilities. So those you may consider within the threshold limits.
Yes.
With that, you would be able to overcome, but you may not be able to do any recovery action because of the government's involvement also in this sector, other than scheduling and allowing them to time for payment. But recovery action, in the sense, not in the form of recover your funds, but constant touch with those entrepreneurs will make you them understand and come to certain agreements for you to recover your money.
Okay, sir. Okay.
Right.
Thank you. Thank you very much for the session.